Innovate and Namaskar. This is the usual monetary policy statement, and there are four aspects of the statement. In the first part, I would spell out the deliberations which took place in the MPC and the decision of the MPC. In the second part, I would provide some guidance to financial markets. In the third part, I would announce some additional measures, and we have a number of them this time. And in the fourth part, which is the concluding part, I would conclude by spelling out our approach in the coming months and going forward. The Monetary Policy Committee met on 2nd, 3rd and 4th December. It reviewed current macroeconomic and financial developments, both domestic and global, and the evolving outlook for the Indian economy. At the end of its deliberations, the MPC voted unanimously to leave the policy repo rate unchanged at 4%. It also decided to continue with the accommodative stance of monetary policy as long as necessary, at least through the current financial year and into the next year, to revive growth on a durable basis and mitigate the impact of COVID-19, while ensuring that inflation remains within the target going forward. The marginal standing facility, that is MSF rate, and the bank rate remain unchanged at 4.25%. The reverse repo rate stands unchanged at 3.35%. I wish to take this opportunity to express my appreciation of the committee members for their valuable insights and guidance that contributed to the monetary policy decision taken today. I would also like to thank our teams in the Reserve Bank of India for their analytical and intellectual support and logistical assistance. Let me begin by setting out the thinking that went into the MPC's decision today and its rationale. The MPC was of the view that inflation is likely to remain elevated, with some relief in the winter months from prices of perishables and bumper Kharif arrivals. This constrains monetary policy at the current juncture from using the space available to act in support of growth. At the same time, the signs of recovery are far from being broad-based and are dependent on sustained policy support. A small window is available for proactive supply management strategies to break the inflation spiral being fueled by supply chain disruptions, excessive margins and indirect taxes. Further efforts are necessary to mitigate supply-side driven inflation pressures. The MPC will monitor closely all threats to price stability to anchor broader macroeconomic and financial stability. Accordingly, the MPC decided today to maintain status quo on the policy rate and continue with the accommodative stance as long as necessary, at least during the current financial year and into the next financial year, to revive growth on a durable basis and mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. The year 2020 has been extremely challenging. It has tested and stressed our capabilities and even our inner reserves of strength, patience and fortitude. As the year draws to a close, it would be appropriate to review our actions and the outcomes as we battled against the pandemic. What stood out, in my view, in all this endeavor was our determination to fight and overcome every trial that was flung at us. I am reminded here of the words of Mahatma Gandhi, and I quote, "Strength comes from an indomitable will." Drawing lessons therefrom, I shall try to set out our vision for the way forward. 2020, in fact, has been a year to remember. When the definitive history of this pandemic period is written up, the year 2020 will be recorded as a defining year in the history of modern civilization, marked by the great pandemic comparable in its scale to the Spanish flu of 1918 and exceeding the economic losses of the Great Depression of the 1930s. The COVID-19 broke out even as the world was gripped by a synchronized slowdown in activity. And this is precisely what made the agony even more excruciating. Alongside this human and economic tragedy, history will also record the unprecedented response by central governments, by central banks and governments, healthcare systems and personnel, civil society organizations, and above all, the common people. Together, we have managed to contain human losses, ensured that financial systems and markets function normally. We have kept finance available and flowing, and reached out to the most vulnerable. The result was that near-term financial stability risks have been contained. Economic contractions have started to ease. Portfolio flows into emerging markets have recovered, and hard currency bond issuances have strengthened for those with stronger credit ratings. Throughout this period, the Reserve Bank acted preemptively to face head-on the challenges posed by the virus and manage the fallout of the pandemic on the Indian economy. Our overall endeavor is that going forward, output and employment losses get quickly recouped in an environment of macroeconomic and financial stability. With preservation of financial stability and depositors' interest being uppermost in our agenda, we could swiftly resolve the situation at two scheduled commercial banks. We remain strongly committed to preserve the stability of the financial sector and will do whatever is necessary on this front. While we are constantly focused on strengthening the regulations and deepening our supervision, financial sector entities like banks and NBFCs in particular should give highest priority to quality of governance, risk management, and internal controls. They are the first line of defense in matters relating to financial sector stability. The Reserve Bank's role as the debt manager and banker to the government was tested to the hilt in 2020, marked by the highest ever level of market borrowing. Our policies have resulted in the lowest average cost of borrowing in 16 years and the highest weighted average maturity of the stock of public debt on record. The government borrowing program, both the central government borrowings as well as the state government borrowings, this has progressed smoothly so far in the year, and I would like to reiterate what I said in October: the importance of cooperative solutions for orderly market movements. We need to be competitive and not combative. Let me now focus on financial market outlook. The measures taken by the Reserve Bank over the year gone by have also resulted in a significant moderation in the structure of interest rates across the spectrum, narrowing of risk spreads, and a record issuance of corporate bonds. Corporate bond spreads have in fact narrowed to pre-pandemic levels across the term structure. Financial markets have been working in an orderly fashion. The easing of finance conditions is in fact preparing the ground for strengthening the nascent recovery, the nascent signs of recovery that have become visible in the second half of 2021. These developments attest to the efficacy of the Reserve Bank's liquidity management measures, not just in lowering yields and borrowing costs, but also in building positive market sentiments as well as confidence in the assurances given by the Reserve Bank of India in October and the actions thereafter to anchor the guidance provided during the last MPC. Overall bond market conditions have evolved in an orderly manner and engendered congenial conditions for other segments of financial markets that price financial instruments off G-Sec yield curve. Debt management operations, monetary operations, and market expectations are in harmony and share a common outlook. This augurs well for financial stability. I take this opportunity to commend market participants for responsible behavior and for contributing significantly to producing these positive outcomes. The Reserve Bank, on its part, stands ready to undertake further measures as necessary to assure market participants of access to liquidity and easy financing conditions. In the external front, the hardening of yields in the US reflects the lift from reflation trade. Prospects of political stability and expectations of fiscal stimulus have churned up risk appetite, causing investors to exit safe haven of US Treasuries and search for returns. As a consequence, surges of capital flows have flooded into India. The Reserve Bank has been taking measures for dampening volatility and enabling orderly evolution of the exchange rate in consonance with the underlying domestic fundamentals. Mindful of the consequences of these actions for domestic liquidity and inflation, the injections of liquidity through forex interventions are being sterilized by absorptions through the reverse repo. We will continue to respond to global spillovers in order to secure domestic stability with our liquidity management operations. The various instruments at our command will be used at the appropriate time, calibrating them to ensure that ample liquidity is available to the system. I repeat, we will use various instruments at the appropriate time while ensuring, and I repeat, while ensuring that ample liquidity is available to the system. Instruments like OMO purchases, operation twists, and reverse repos will continue to be used. Our paramount objective is to support growth while ensuring that financial stability is maintained and preserved at all times. Let me now turn to assessment of the growth and inflation outlook. Let me first set out the MPC's assessment of underlying inflation dynamics and the outlook. CPI inflation rose sharply to 7.3% in September and further to 7.6% in October, with some evidence that price pressures are spreading. The outlook for inflation has turned adverse relative to expectations in the last 2 months. While cereal prices may continue to soften with the bumper Kharif harvest arrivals and vegetable prices may ease with the winter crop, other food prices are likely to persist at elevated levels. Cost push pressures continue to impinge on core inflation, which could remain sticky. Taking into consideration all these factors, CPI inflation is projected at 6.8% for Q3 2021, 5.8% for Q4 2021, and 5.2 to 4.6% in H1 of 21-22, with risks broadly balanced. Against this backdrop, we must now turn our attention to nurturing the recovery beyond meeting up of the pent-up demand and focus on setting it on a firm trajectory of sustained and high-quality growth. Data that have become available for Q3 2021 confirm that the economy is recuperating faster than anticipated, and more sectors are joining the multi-speed return, the multi-speed upturn that I had highlighted in my statement in October. The contraction in Q2 in the NSO's end November preliminary estimates has turned out to be shallower than projected in October. The Manufacturing and Services Purchasers Managers Index, that is PMI, at 56.3 and 53.7 respectively in November 2020 remain in expansion zone. High-frequency indicators of services showed stability and increase in the number of optics. In fact, I have spelled out some of these details in the annex to my statement, which of course I would not be reading out because in the interest of time. The recovery in rural demand is expected to strengthen further, while urban demand is gaining momentum as unlocking spurs activity and employment, especially for the labor displaced by COVID-19. These positive impulses are, however, clouded by a possible rise in infections in some parts of the country, prompting some local containment measures. At the same time, the recovery rate has crossed 94% and is rising, with considerable optimism on the successes in vaccine trials. Consumer confidence over the year ahead has also turned optimistic. Corporate results for Q2 2021 indicate that demand conditions are recovering and profit margins are rising on the back of cost saving on expenses and debt servicing capacity has also gone up. Business assessment for manufacturing firms has entered the expansion zone in Q3 2021 after remaining in contraction in the last 2 quarters. Business expectations going forward into Q4 2021 are also rising. Turning to growth outlook, as I just stated a little while earlier, the recovery in rural demand is expected to strengthen further, while urban demand is also gaining momentum. Consumers remain optimistic about the outlook, and business sentiment of manufacturing firms is gradually improving. Fiscal stimulus is increasingly moving beyond being supportive of consumption and liquidity to supporting growth-generating investment. On the other hand, private investment is still slack and capacity utilization has not fully recovered. While exports are on an uneven recovery, the prospects have brightened with the progress on vaccines. Taking these factors into considerations, the real GDP growth for 2021 is projected at minus 7.5. I repeat, the real GDP growth for 2021 is projected at minus 7.5. And the breakup would be as follows. The first 2 quarters are already known. And for Q3, we are projecting plus 0.1%. And for Q4, we are projecting plus 0.7% in, as I said, in the Q4. So, in other words, the H2 is expected to show positive growth. And the projection for the H1 of next year, that is 2021, is projected at 21.9% to 6.5%. Against this background, we, as I said earlier, our focus, we have now turned our focus to providing further support measures in the interest of growth, maintenance of financial stability, and other factors which I just mentioned. So, against this backdrop, the RBI will persevere with its paramount objective of reviving the economy with some additional measures in order to enhance liquidity support to targeted sectors having linkages to other sectors, deepen financial markets, conserve capital among banks and NBFCs through regulatory initiatives, strengthen supervision through strengthening audit functions, facilitate external trade by improving ease of doing business for exporters, and upgrade payment system services so as to expand financial inclusion and improve customer service. The on-tap targeted long-term repo operations, that is the on-tap TLTRO, announced on 9th October 2020 will now be expanded to cover other stressed sectors in synergy with the credit guarantee available under the Emergency Credit Line Guarantee Scheme, that is ECLGS 2.0 scheme of the government. This will encourage banks to extend credit support to stressed sectors at lower cost. The next announcement relates to regional rural banks. RRBs are currently not permitted to access the liquidity windows of the Reserve Bank of India as well as the call or notice money market. With a view to expanding participation in money markets and to facilitate better liquidity management, regional rural banks will now be allowed to access the liquidity adjustment facility, that is LAF and marginal standing facility, MSF, of the RBI, and also the call or notice money market. With the recent enactment of legislation for bilateral netting of financial contracts providing a fillip to underdeveloped credit derivatives market in India, it has been decided to review the extant guidelines on credit default swaps and issue draft directions for public comments very shortly. The revised directions are expected to facilitate the development of credit derivatives market and a liquid and vibrant market for corporate bonds, especially for the lower rated issuers. In light of evolving In the light of evolution of the financial markets and due to various liberalization measures undertaken in the recent period, the comprehensive guidelines on derivatives issued in 2011 have been reviewed and draft directions are being issued today for public comments. The revised guidelines seek to promote efficient access to derivatives market while ensuring high standards of governance and conduct in the over-the-counter, that is in the OTC derivative business by market makers. Comprehensive draft directions on call, notice and term money markets, certificate of deposits, commercial papers and non-convertible debentures with original maturity of less than 1 year are being released today for public feedback. The revised directions seek to bring consistency across products in terms of issuers, investors and other participants. These announcements which I made may sound a bit technical, but I can assure you that they will go a long way in promoting, and developing the corporate bond market and the derivatives market in India. Time will tell how effective they are, but we are very optimistic that this will definitely give a fillip to the corporate bond market segment and also to the money markets. Let me now turn to regulation, and I will highlight some measures relating to banks. In response to COVID-19 pandemic, the Reserve Bank has focused on resolution of stress among borrowers and facilitating credit flow to the economy while ensuring financial stability. In continuation of this effort and to help banks conserve capital while creating room for fresh lending, which is very, very important, especially in the context of post-COVID revival, it has been decided after a review that commercial and cooperative banks will retain the profits earned in 2019-20 and not make any dividend payout from the profits pertaining to the financial year 19-20. The growing significance of NBFCs and their interlinkages with different segments in the financial system has made it imperative to enhance the resilience of the NBFC sector. Therefore, it has been decided to put in place transparent criteria as per a matrix of parameters for declaration of dividends by different categories of NBFCs. A draft circular containing the proposed criteria and parameters will be released soon for public comments. As you can see, in most of the cases, we are releasing draft circulars, we are releasing discussion papers so that we get public feedback, we get stakeholders feedback, and as I have always said, and this has been my consistent view, that such inputs received from stakeholders and the public definitely deepen the quality of our decisions, enrich the quality of our decisions, and we will continue to pursue that. That is why we have been, as I said, we are straight away not issuing the circulars, but we are putting draft circulars in the public domain for comments. Further, the current regulatory regime for NBFC sector, built on the principle of proportionality, warrants a review. It is felt that a scale-based regulatory approach linked to systemic risk contribution of NBFCs could be the way forward. As part of the stakeholder consultation process, a discussion paper on this subject will be issued before January 15th, 2021 for public comments. Turning to supervision, our supervisory focus in improving the governance and assurance functions in supervised entities continues to engage the attention of the RBI. In this endeavor, the following measures are being announced today. These pertain to, number one, introduction of risk-based internal audit in large UCBs and NBFCs, and number two, harmonization of guidelines on the appointment of statutory auditors for commercial banks, urban cooperative banks and NBFCs to improve the quality of financial reporting. Details on these measures are in Part B of the MPC statement, MPC resolution, and the guidelines on these will be issued shortly. Turning to digital payments security, in order to significantly improve the ecosystem of digital payment channels with robust security and convenience for users, we propose to issue Reserve Bank of India Digital Payment Security Control Directions for the regulated entities. These directions will contain requirements for robust governance, implementation and monitoring of certain minimum standards on common security controls for channels like internet and mobile banking, card payments, etc. Draft directions in this regard will be issued shortly for public comments. With regard to financial literacy and education, I have one announcement to make. In order to deepen financial inclusion and financial literacy, a community-led participatory approach through Centers for Financial Literacy, I repeat, through Centers for Financial Literacy, CFL, was implemented by the RBI through select banks and non-governmental organizations as a pilot project in 2017. It is now proposed to expand the reach of CFLs from 100 blocks currently to every block in the country in a phased manner by March 2024, and I think this is a very important step which will promote financial literacy and financial inclusion across the country, even in the most underdeveloped and backward parts of the country. With regard to grievance redressal mechanism in banks, I have the following announcement to say. With a view to enhancing the efficacy of grievance redressal mechanism in banks, it has been decided to put in place a comprehensive framework comprising inter alia, enhanced disclosures on customer complaints, monetary disincentives in the form of recovery of cost of redress of complaints, that is especially if there is no redress or if there is delayed redress, there will be a scheme of system of disincentives so far as the regulated entities are concerned. Then we will also undertake intense review of grievance redress mechanism and initiate supervisory action against regulated entities which fail to improve their redress mechanisms. With regard to external trade facilitation, and there are some procedural changes which we are making, and we are confident that this will improve the ease of doing business for exporters and will really help our export sector. The Reserve Bank has announced several measures in the past to enhance export competitiveness, ease of doing business for exporters, and minimize procedural delays. Continuing with these efforts, it has been decided to further facilitate external trade by delegating additional powers to authorized dealer banks, AD banks, to regularize cases of direct dispatch of shipping documents by exporter irrespective of the value of export shipment. Similarly, to write off unrealized export bills without limits in specified circumstances. And the next one is that the AD banks are also being delegated with additional powers to allow set-off of export receivables against import payables with overseas group or associate companies under certain conditions, and also to consider refund of export proceeds without insisting on import of goods which are perishable in nature or had been auctioned, destroyed by port or customs or health authorities or any other accredited agency in the importing country, subject to production of certain documents. Now, these announcements may sound very complicated, but let me assure you, the export sector and the exporters do know that what kind of ease of doing business it will facilitate and how it simplifies their day-to-day activities and operations. And finally, let me turn to certain changes we are making with regard to payment and settlement systems before I conclude my remarks today. The RTGS system will soon be made 24/7 in the next few days, and this was announced in the last MPC. With this enablement, it is proposed to reduce settlement and default risk in the system by facilitating settlement of AEPS, IMPS, NETC, NFS, RuPay, UPI transactions on all days of the week. Instead of 5 days earlier, now they will be done on all days of the week. This will make payments ecosystem more efficient. In order to expand adoption of digital payments in a safe and secure manner, it is proposed to enhance, at the discretion of the user, the limits for contactless card transactions and e-mandates for recurring transactions through cards and UPI from rupees 2,000 to rupees 5,000 from 1st January 2021. Let me now just conclude, and I now come to my concluding remarks. Thank you very much for your patience. The growth impulses that have emerged augur well for the revitalization of the Indian economy. Policy stimuli by government and the RBI are intended to nurture these growth sprouts to greater strength. Efforts are underway to ensure a calibrated unlocking of the economy, with cognizance and caution about the virus. While we remain vigilant, we must now turn to alleviating the scars left by the pandemic and revive the economy. The horizon has lighted up with a spate of positive news on the vaccines and a steady rise in recoveries. India's time has come to break free of the fetters of COVID-19 and reconfigure our destiny. We have borne with fortitude and courage the terrible havoc wrought by the pandemic. We have lost lives and loved ones, but not hope, not the conviction that we will overcome and emerge stronger. It is often said that life after COVID will not be the same again, but human endeavor has time and again shown that it is never too late to seek a newer world. We must reach out with a strong will to strive, to seek, to find, and not to yield. I am reminded here of a quote attributed to Socrates. In the face of adversity, we have a choice. We can be bitter or we can be better. Obviously, we will strive to be better. Stay safe, stay well. Namaskar.
All right, interesting choice of words by the RBI Governor Shaktikanta Das. As the market was expecting, it's a status quo as far as the policy is concerned, accommodative policy stance, but a change in the RBI's projections for GDP as well as inflation. In fact, not just that, the RBI has said that they are going to propose to issue digital payment security control guidelines as well. This, of course, following the outage of HDFC Bank as well as the YONO apps that we saw yesterday, and also risk-based audit coming in for large NBFCs. So a handful of things, of course, apart from various liquidity-related measures as well. Let me take it across to our consulting editor, Maithili Busnarmata. Maithili, your first thoughts on the policy, pretty much on expected lines, but many were expecting that the RBI's GDP projections would be changed just a little bit, but looks like RBI is far more optimistic, albeit, of course, one has to keep into account a rise in COVID-19 cases as well.
Well, as I said even before the governor's speech, that I would take all GDP projections made at this juncture with a pinch of salt, maybe with more than a pinch of salt, 2 pinches of salt. But what I am a little intrigued by is that the RBI, despite the shift to inflation targeting, the governor clearly seems to indicate that the RBI has now put growth on the front burner, and inflation seems to have got put back on the back burner quite considerably. If I may just quote, he says, in fact, and I just quote over here, after saying that inflation is likely to be elevated and core inflation particularly is going to remain sticky, he says the paramount objective is to support growth while maintaining financial stability. So in this particular sentence, at least, there is no mention whatsoever of inflation. This from an inflation targeting bank, central bank, at a time when inflation is running well over the uppermost band of their 4 to 6%. So I'm a little intrigued by why RBI seems to suddenly think, despite, I said, the shift to inflation targeting, that its focus should be rather on growth at a time when growth, by his own admission, governor's own admission, seems to be improving and inflation is elevated. So if we look at the GDP estimate and the inflation estimate, GDP estimate, they've improved. The inflation estimate has worsened. Despite that, RBI seems to have shifted its focus to growth. And to that, my mind, that seems a little contradictory, particularly because, as I said, markets in fact expected and anticipated that there would be some nuanced statement of how liquidity is concerned, whereas the governor reiterated the statement that he made earlier, before we got the new GDP numbers, before we saw how inflation was going to remain elevated, that The RBI will maintain its accommodative stance not only in this fiscal but also the next fiscal. That, to my mind, is a little at odds with an inflation targeting bank at a time when inflation is very high, growth is reviving, and as by the governor's own admission once again, we are seeing a huge influx of forex. Whatever the RBI does to sterilize forex inflows, this is not going to be adequate given the kind of surge of inflows that we've seen, and ultimately we are going to see a resurgence of inflation once again. To my mind, the RBI seems to be once again walking the path that it did in 2008. I do hope that we do not end with the same sorry consequences.
We sincerely hope that. For now, though, look at the markets. I just wanted to mark that before we move forward with our conversation with Abhik Barua as well. We're at the day's highs. While it looked like it's going to be a very tentative, muted sort of start, at least that is what the SGX Nifty as well was indicating. We're at record highs right now. We've already nudged that 13,280 level in trade, which is a fresh record high for the index, a lifetime high, so to speak. We're up a good 85 points for the Nifty futures right now. The breadth of the market also looking intact, and banks in particular, I want to mark that sector out, because while it started off the day in the red, you've seen a massive recovery come in the banking sector. About 1.5% is the kind of contribution that you're getting from the Nifty Bank within the F&O universe. The MPC decided to continue with its accommodative stance of monetary policy as long as necessary, at least till current financial year and into the next year, to revive growth on a durable basis and mitigate the impact of COVID-19 while ensuring that inflation remains within target. I think the market has really picked up its cues from here. Abhik, the governor sounding very philosophical towards the end, quoting Socrates. But what's been your takeaway on what his commentary on the interest rates was like?
I think the pause on interest rates was anticipated. I think I share sort of Maithili's concerns about the absence of any emphasis on high inflation and any consequent action on the liquidity front. We seem to have at least implicitly, jettisoned strict, or the jettisoned constraints imposed by very strict inflation targeting that were there in the past. Perhaps this is a response to an extraordinary situation, which is the pandemic. Perhaps the governor is trying to tell us that, yes, growth is recovering, and it's recovering at a faster pace than most of us anticipated. But all this is happening under the long shadow of the pandemic with its associated uncertainties. So it's perhaps best to prioritize things. And at this stage, given the uncertainties about the durability of growth going forward, the needs of the banking system and the markets to support this growth, perhaps inflation and liquidity can take a back seat. Although I think this kind of a strategy, if it sustains for too long and growth continues to surprise on the upside, has the potential of breeding inflation risks,
right.
In fact, on a more permanent basis going forward. As I said just right before, his statement, sure, that this is not just in a couple of vegetable prices moving up. This is more sustained and becoming more broad-based.
Sure. In fact, we have Mr. K.K. Mistry as well from HDFC joining in on the phone line right now. Mr. Mistry, morning. Good to have you on the show. Along expected lines, a status quo policy coming in. But do you think enough was done to address the excess liquidity, the inflation concerns and growth concerns?
I think at this moment it is more important to ensure that the growth that we have seen over the last few months sustains, and not only sustains but also picks up. So therefore, I think it's absolutely the right thing that RBI has done by maintaining interest rates and by maintaining the accommodative policy.
Mr. Mistry, hi. Mr. Mistry, hi. Good morning. This is Ruchi Bhatia. In fact, while the RBI has revised their GDP forecast as well as inflation forecast as well, interesting commentary coming in as far as the NBFC space is concerned, where they're saying that risk-based audits will be done for NBFCs. Of course, a push coming in after the internal working group of the RBI also suggested that some of the good NBFCs should be converted into banks. So how do you look at the RBI's comments coming in on the NBFC front?
Well, I just frankly did not hear the comments. That's from what he mentioned. I think it was like expected after the policy paper that the regulatory environment would be a little different depending upon the size of the NBFC. The smaller the NBFC, the lighter the regulation, the bigger the NBFC, the stronger the regulation. I don't see that to be too much of a concern, to be honest. Secondly, as far as this conversion to banks is concerned, there, what we've seen in that working paper is it's a draft, it's a working paper of a group. It's not a mandate. It's not something which RBI has yet adopted. It's up for public comment. One will have to see the final guidelines when they come, in what shape they come, in what kind of pathway they create for NBFCs to convert into banks, whether there are any exemptions which are given in terms of CIR, SLR, priority sector lending, on the existing balance sheet. So I think all NBFCs will look at it at that point of time and take a call on that.
Actually, here, your first reaction to the governor's statement, would bond markets be happy or would they be wary? Because they know that good times like this really cannot last. Nilesh?
I think RBI's current policy is in continuation of their several steps taken during last 6 months. It's pro-growth measures. There is ample liquidity, but no lending materially happening despite several credit guarantee schemes. There is extremely low capacity utilization, and yet inflation is high. So there are several challenges which RBI is grappling with, and they have decided to give a policy which is pro-growth.
Nilesh, if I can come to you once again, the RBI, the governor lauded the RBI's liquidity management policy, but in justification of RBI's policy stance and how good it has been, he kept talking about how corporate yields, bond yields have come down, how government security yields have come down. He did not at all talk about inflation. So is there some kind of a misunderstanding or whatever, at least to my mind, the RBI's liquidity stance, you need to laud your liquidity stance if you manage to keep inflation under control, because that is the first and perhaps I would say far more important objective of a central bank. Managing yields on corporate bonds follows from that. Whereas the RBI governor was lauding its liquidity management and showing the corporate bond yield decline, whereas inflation has gone up. So you failed in your primary task. So what is the point of patting yourself on, doing something on your secondary task reasonably okay? Because that has happened nearly entirely because of liquidity surplus, not because of a liquidity management. Nilesh?
One central bank which is focused on inflation right now. At one point of time, European Central Bank was lauded for their inflation targeting. Today, European Central Bank is pumping liquidity and not bothered about inflation. Reserve Bank of New Zealand was the first central bank in the world where governor's pay was linked to achieving inflation targets. Now they have abandoned that. I think Reserve Bank of India needs to go back to the role where they play an all-rounder role of managing inflation, supporting growth, managing government's borrowing program, managing Indian currency and financial system. Narrowing RBI to just focusing on inflation will be not a right step. We have taken the path of inflation targeting without even having clear definition of inflation. Your WPI inflation is way below RBI's target level. The CPI inflation today has components which is highly volatile like food, fuel, gold. The core inflation excluding food, fuel and vegetables and pan, tobacco kind of sin products and gold, that number is well within RBI's comfort zone. So do we have clear definition of inflation? I think we need to understand that by raising Indian interest rates, we are not going to influence global oil prices. Today, we are in need of growth, and RBI has taken several steps to support growth. if for 3-6 months we let go inflation, which is more of a supply side issue, then probably it will be positive for overall economy. We will always have opportunities to bring back inflation under control at a later date.
I'm not sure you agree with Nilesh, because I most certainly don't. And I have two main points where I disagree with him. First, he compared India with the ECB, the RBI with the ECB. Look at the per capita income in the Eurozone and look at our per capita income. Look at inflation in the Eurozone, look at our inflation. Secondly, he spoke of how, yes, there are misgivings about inflation targeting, and a very rigid adherence to inflation targeting is perhaps not very wise. But Nilesh said that the RBI's job should be to manage inflation. Now at 7.6% at the last count and close to 7% for the last 7 months in a country which is poor, I wouldn't say dirt poor, but we are a very poor country, and we have a large section of the population below poverty line for whom food inflation is perhaps the most critical. So is the RBI A, managing inflation? B, is the comparison of the RBI and the ECB correct? Or B?
No, I kind of tend to agree with you. I think the comparison with the ECB or indeed some of the other Western central banks, which are doing very aggressive monetary easing, is perhaps not entirely valid here because their inflation rates are much lower. We do have a problem with inflation. And one is not asking for a complete reversal in policy, a hike in rates, or anything as extreme as that. I think what you seem to suggest and where I tend to agree with you is that some acknowledgement that inflation has kind of slipped out of control. It's not just a short-term supply problem, and that certain things can be done as preliminary steps to manage it. And I think these preliminary steps would largely be on the liquidity front, where, I mean, there are risks of more and more flows coming in. I think that commentary was missing. And maybe the RBI sees most of the inflation as a short-term supply shock. But with the kind of inflation rates that are there in the system, and with the kind of growth expectations that are significantly revised upwards from the previous round of forecast, one would expect a little more emphasis on inflation. And the problem where I disagree with Nilesh, and perhaps he is right, but is that once you sort of lose control of inflation, and where you see the persistence, where you see core inflation elevating, where you see the first signs of pass-through of costs to final products, if you just look at the WPI inflation very closely, you cannot switch it off. It just tends to get embedded in the system. That has been our experience in the early part of this decade, or was the previous decade, around 2011 to 2012. And if you remember that we had sort of a sustained period of inflation that we kept grappling with unsuccessfully. And I'm a little worried that that might just happen if you keep kind of ignoring inflation altogether. I do think there has to be an emphasis on growth. I don't think rate increases are necessary, but some acknowledgement and some liquidity responses was perhaps warranted. Maybe it will come in the next policy.
Mr. Shetty, your first reaction to the RBI policy, and would you agree with Obhik and me, or would you rather agree with Nilesh? And I think somehow the RBI's attitude toward inflation seems to be fought a number of bouts, retired hurt, because they seem to have given up on the inflation front and focused on growth, and also focused on getting government bond yields, down. Yes, the RBI is a full-service central bank. They have many roles, and it's a question of which one comes to the fore at a particular juncture. But surely inflation in a country as poor as India is perhaps primary to a central bank. Mr. Shetty?
Yeah, good morning. I think from the current situation, as you rightly mentioned, what decision needs to be taken at what juncture? So we believe that at this juncture, what is important is that we need to send signal growth is important. And we are still not out of woods, right? While the number of cases has come down and the opening up of economy has happened and the rebound seems to be real. But I think still it is important to give a direction. I think what we are glad to know that there's an explicit forward guidance in terms of accommodative stance, not only for FY21, FY22, and that gives scope. Comfort to the markets in terms of what is RBI's thinking, and I believe that this stance of accommodation is important at this juncture. So I think to that extent, my first reaction is very positive on this.
Real rates of interest as damaging in the long term, because ultimately today all depositors are getting negative real rates of interest. Borrowers have never had it so cheap, and yet credit is not picking up. And bankers say it's not because they are not willing to lend. So either you have to say that you're not willing to lend, or you need to say that these negative real rates of interest are not low enough. So which way would you veer, Mr. Shetty?
No, I think earlier also I had stated that the economic recovery will have to proceed before the credit recovery happens. If you see, my take on this is that if, as RBI anticipates that Q3, Q4 will have a positive growth back into picture, there bound to be some credit growth. Whatever credit growth has been happening now is mainly on the retail space. And what we are seeing is certain amount of investment credit is picking up even in the corporates. It may not be perceptible, but there are inquiries. There are in terms of asking for new facilities. I think that would further strengthen as we go forward. And for the last 2 quarters, Q1, Q2 has been extremely tough. And prior to that also, as you know, credit growth has not been picking up. The rebound will accompany the credit growth. That is what we believe. The real rates of interest in the inflation, I think there's a lot of debate in terms of whether it is a supply-related inflation or demand-related inflation. While we keep that aside, the focus should be on growth. I think to that extent, whatever we are currently witnessing is in the right direction.
Right. Abhik, if I can come to you, the RBI, as Maithili was pointing out, is now keeping a single-minded focus on growth from here on. But if you look at private investment, that is still very weak. When do you see a real revival really happening? Because if you look at the growth projections that have been put out by the RBI, for Q3, they're saying the growth expectation is plus 0.1%, Q4 0.7%. That would mean that it is going to take some time before private investment actually start flowing in.
As Mr. Shetty just mentioned before me, that we are beginning to see, and I'm talking from our bank's perspective and for banks in general, that we're beginning to see the first queries about at least brownfield expansion, perhaps not large greenfield expansions. And there are certain segments where they are running at reasonably high capacity utilization rates. The entire sort of rural plays like tractors, like some of the utility vehicles that feed into rural demand are operating pretty much at full capacity, looking for expanding capacity. But you cannot in this kind of sort of semi-recessionary environment think of any major improvement in private investment activity. Private investment activity that is linked to infrastructure projects where the government is taking the lead could see some traction. But for a broad-based increase in private investment activity, I think we'll have to wait till the end of 2021, where there is some further pickup in the economy and some significant and sustained improvement in capacity utilization. I think if you were to try and rationalize the governor's statement, although he made these forecasts which were far more rosy than what the RBI had made in the past, and it seems to suggest a reasonably strong rebound. I think there is enormous concern at the RBI about the durability of this, the uncertainties associated with the infection and the consequent impact on the economy, and a bunch of other things, which sort of required it to stay on guard and continue its vigil on growth. I think the limited point is that some recognition of the inflation pressures that are building up, and perhaps a little, I mean, no one is expecting, no one is asking for a shift in focus away from growth. But you can continue to focus on growth, but just, sound very tentative and very soft, it rings some very soft alarm bells on the inflation front. Perhaps that's all that we could have asked for, but we were disappointed. Maybe it'll come in the next policy if indeed the growth momentum sustains.
Well, we've been talking about as to how the governor did not quite address liquidity, but look at what liquidity alone can do for equity markets. $8 billion worth of inflows in the month of November and consistent inflows so far as well in the month of December. We've made it to 45,000 on the Sensex. It's a fresh record high and it has to be marked definitely. And it's a very lively broader market as well. A good 100 stocks within the F&O universe are standing to the advances. Names like Hindalco have surged about 5%. Ultratech Cement, after the capacity expansion plans that they announced yesterday, that's holding up 5%. Interglobe Aviation, after now that airlines are going to be running at 80% of the pre-COVID capacity, that announcement coming in yesterday, 5% move on Interglobe Aviation. Tata Power, DLF, and banks in particular, they're the ones which are holding up very, very smartly. Bharti, ICICI Bank, L&T, Shree Cement, Hero Motocorp, Tata Steel, ITC, they are the ones which are holding the markets up as we speak right now. But Mr. Sethi, if you can really answer this question, and there's much consumer curiosity as well over here. Given the YONO app outage yesterday and the governor right now mentioning that the RBI is proposing to issue digital payment security control guidelines, help me understand what kind of direction could these guidelines take, and then what would it really mean for you at SBI?
As far as the YONO app is concerned, we have explained to our consumers, and interestingly, we have two more flagship apps, internet banking as well as YONO Lite, which were operational yesterday. So there was no complete disruption of availability of the platforms, number one. Number two, I think RBI as a regulator would like to ensure that the sufficient infrastructure investment is being made before the digital channels are opened up. In fact, what we believe in SBI is that the digital channels, which were initially thought to be good to have channels, when you have a branch channel, you have ATM channel, and you have Bank Mitra's channel. In the past, digital channel probably was considered as a kind of good to have channel, but they are slowly becoming mainstream channels. Particularly during the pandemic, we have noticed that the migration to the digital channels has been immense. Both either on the bank-owned apps as well as UPI, there have been a significant volume rise. So I think the regulator would like to see that the banks don't lose sight of constant improvement in the infrastructure. That is what I believe. And when they talk about the payment infrastructure and security strengthening, essentially, it is not only in terms of cybersecurity aspects. It is also the continued availability of whatever channel banks have rolled out to their consumers. Because once the migration happens, the digital migration happens, and then you not able to ensure the continued availability of the channel would be deficiency in the customer service. I think that is where the RBI is coming from. And we are extremely mindful of that. If you have noticed that, we have pumped in a lot of money in terms of infrastructure strengthening. It is not only increasing the offerings on the YONO app. We've been focusing on how do we strengthen the app itself, and not only that, the overall digital channel offerings have to be backed by the robust infrastructure. I think if I have to take one learning from whatever action RBI has taken yesterday, as well as the direction which they talked about today, point out that the banks have to be mindful of the infrastructure investment and continued availability of the digital channels.
Oh, absolutely. In fact, digital banking is going to be the way forward, and in that sense, the RBI is trying to ring fence the system even more, ensure that internal systems are properly put in place. But Mr. Shetty, if I can come to you on some of the measures that have been announced for the stress sectors on the TAP. TLTROs, the RBI has given an extension to some of the stress sectors as well, pretty much in line and synergy with the ECLGS scheme as well that was announced by the government. So what kind of a relief do you expect for the stress sectors coming in now that there is going to be larger liquidity gush into these stressed sectors?
So as you know, the ECLGS 2.0, which was announced by the government recently, had covered 26 stress sectors as identified by Kamath panel, as well as healthcare sector in addition to that. So out of this 3 lakh crore, which is earmarked for this scheme, around 2 lakh crore has been sanctioned so far. Now they have enhanced the scope of the scheme to cover these stress sectors as well as healthcare. What is additionally what RBI is now providing is that originally when in October online untapped TLTRO was announced, it was restricted to 5 major ones like agriculture, agri-infra and retail MSME. The 5th one is pharmaceutical and healthcare. And now they have permitted these funds to be utilized for these 26 sectors to fund under the ECLGS. I think that is one is of the design of ECLGS itself has been extremely positive. If you see both in terms of geographical coverage and the participation of the private and public sector bank has been extremely good in this scheme. So now that the scope of the scheme is enhanced and the availability of funds under the TLTRO is also made possible, I personally believe that the stress sectors, the eligible companies under the stress sectors would be easily be able to get under the funds under the scheme. While I believe that even without the untapped TLTRO, the involvement of the lenders is very intense in this scheme. But since the 2.0 covers fairly large companies, because there is no turnover requirement and credit facilities up to 500 crores is covered, probably this untapped TLTRO also would supplement the support of funds at a cheaper funds to the banks.
Right. Nilesh, if I can come to you on what the RBI Governor today has said as far as the good and strong NBFCs are concerned, saying that it is felt that it is felt that the scale-based regulatory approach linked to systemic risk contribution of NBFCs is something that one should be looking at, basically trying to say that the large and good NBFCs, perhaps the time has come to regulate it in a better manner. There's a risk-based audit that they've also proposed. Given the fact that the internal working group of the RBI also suggested that some of these good NBFCs that have a certain asset size as well, they should be treated just like banks. Their regulatory systems should be enhanced. How do you look at what the RBI is saying, of course in consonance with the proposed proposals that were put out by the RBI's internal working group as well?
It's a step in right direction. Today, NBFC, cooperative bank, some of the chit funds fall between the regulators, and unscrupulous player in those sectors does take advantage, as is continuously demonstrated in failures of cooperative banks, chit funds, and NBFCs on a regular basis. It is important that regulators work among themselves to ensure that there is nothing falling in between the stools. And this step is in the right direction, where NBFCs will be regulated and governed just like any other financial services entity.
Okay, we are also joined by Ajay Srivastav. Ajay, your first reaction to the governor's statement on the monetary policy, and you share Obik and my, slight apprehension that maybe RBI is walking down the same path it did in 2008. The lessons of 2008 do not seem to have been internalized in the RBI, and the focus on inflation has somehow gone to the back burner at a time when we already have surplus liquidity, which ultimately will creep into inflation in a country like India. Ajay?
No, I think we need to go back to the fact that the RBI governor is an ex-finance secretary who was brought into a situation which we all know about. And therefore, the focus was very clear that RBI is an extension of government policy to focus on getting cheap credit to large corporates. That's what is happening, and that's what will continue. That's an economic policy. That's an RBI policy. And to that extent, that inflation will continue to rage because we're not going to take any steps about it. And he said very clearly in his statement that, listen, I need to focus on growth, which is, you can argue about it, but that's a stated policy. And I think that works well for the equity markets because what has it done is brought the cost of capital down for the large corporates, particularly. And it has given them abundant liquidity in terms of the bond market, debentures, CP rates, etc. So it couldn't have been better for the large corporates. Now, what it did not address is that with high inflation and what's going to happen to the rates for the savers in the economy. That's where the problem is. That you got 8%, 9%, and I think Nilesh somebody said about the Western economies. Now they have social security umbrellas. You don't have to worry in Australia or New Zealand. If you retire, you get a house from the government, you get a pension from the government, medical is paid for. In India, the man needs to save for the period, and that's a 30-year period post-retirement, a 25-year period. Now, if your saving rates go down, inflation at 9%, you're creating a major social security problem down the line, not today. So that's a challenge. The number two is, the elephant in the room is the interest rates to MSMEs. Now, those are still running at 12, 13, 17% interest rates. Those are still not getting addressed. To my mind, it's a continuation of the policy that we must gear up to give large corporates of India good quality, abundant liquidity at cheap cost. I think that policy continues. I think MSME continue to suffer with a high interest rate. That's not addressed in the policy today. And the savers, most important. I think that's the way the calamity is going to come in, because with that inflation rate, what we are seeing today, real effective inflation rate, and we can argue, which is the right bucket, is oil should be there, education, we can argue whatever we want to argue. High inflation rate is going to hit the savers, but wonderful news for stock market and large corporates.
You're an exception. You're a market man. Despite that, I think you have a great deal of empathy for salaried middle-class people like us who really cannot, understand why the RBI has forgotten about inflation completely despite negative interest rates. And your description of the RBI as an extension of the government, I do not know what it will do to many past RBI governors who fought very hard to ensure at least there was a pretense of an independent central bank. But yes, this is good news for markets, but what percentage of the population is really invested in the stock market? That is something I think that the RBI seems to have forgotten about. So what nuance would you have liked to see in today's statement, which took care of ensuring that, yes, corporates get interest, loans at reasonable rates of interest. At the same time, you don't hit the poor savers. So what tweak would you have liked to see in the governor's statement, Ajay?
I think more than even the savers, first one which I'd like to see is how the rate transmission is going to happen to the MSME. How do they bring it to 10% interest rates, etc., compared to 13 or 14 that they're going to be? That is one point. Number two is, government has got some policies, small savings scheme, etc., etc. The senior citizen savings scheme, I think those need to be put under a special umbrella in the banks everywhere, that they kind of get a little bit higher interest rate and at least index-linked bonds for subscription. We have a policy, I think there's something to do with interest rate link, but not index inflation linked bonds, etc. Those need to come into place to secure people, because every rate's falling, and with the tax rate at 30% or thereabout, you really don't make very much post-tax compared to the inflation rate. So I think something to do with special schemes for at least senior citizens, and a special window to see that the banks pass on the benefit of interest rate to the MSMEs. If you have to put a fiat, put a fiat. And I'll tell you one thing. If India's industry has suffered in the past 4 or 5 years, it's only because Indian Central Bank has only looked after the commercial banks. Our banks, whether it's HDFC, Kotak, whatever, have made tons and tons of money, and the industry has struggled through the period. 4% NIMs is criminal for an economy. they need to be brought down to 2.5%, and that's a benefit which has to go to MSME. That's a nuance which I think central bank has to come into place, given the fact that all the priority sector regulations have been diluted. There is nothing much left in terms of social obligation for the banks today.
In on that, would you agree with him that the social obligations are not there on banks? If you look at public sector banks, and State Bank of India has been at the foremost in opening Jan Dhan accounts during the demonetization days were there, during COVID, all your rural branches were opening, public sector bankers, and many public sector bankers in fact sacrificed their lives. So to say that in fact that the banks have made a lot of money and they have made a killing, would that be true of public sector banks at all? And Ajay said, yes, MSMEs need lower rate of interest. And can you do that by fiat? Because ultimately MSME banks, companies also need to be formalized. How do banks lend to MSME sector when they're really not formalized, when you have no means of recovery, when the IBC, etc., has not really worked entirely satisfactorily? So would you say Ajay's comments are more relevant for private sector banks and not so much for public sector banks, Mrs. Shetty?
So first, a few clarifications in terms of MSMEs. Today, while of course the interest rates cannot be strictly mandated, it's a market-driven mechanism. But in terms of MSME lending, the Reserve Bank of India had mandated that the interest rates have to be linked to the external benchmark. So much of the book in the public sector bank, at least, I do not know the data from the private sector banks, we have currently cannot lend any new MSME loan without linking it to the external benchmark. I think he was talking more in terms of the transmission. So to ensure effective transmission of interest rate, it is mandatory for banks to lend to MSME, which are the rates which are linked to the external benchmark. That is number one. And even among the legacy loans, and all the loans have to be eventually linked to the EBLR, and which we have done in the last 3 months. Much of the MSME book has been moved to the repo-linked rates. That is number one. So the transmission is effectively ensured. Then the issue is on the spread over the EBLR. I think a lot of people say that when you are lending at 5%, 6% to the corporate, how can you not lend at that rate to MSME? I think there has been a lot of softening of interest rate among the bank rates to the MSME. The challenge is not the banks charging higher rates to MSME. I think the rates are all right. But the problem is that the formalization of MSME lending towards the commercial bank has not fully happened. If you really see, more than 90% of MSMEs borrow from the non-banks. So that is where the interest rates are higher. I think why the interest rate again in the NBFC and the MFI sector to the MSME is higher, because again the delinquencies are higher, the collection costs are very, very significant. Obviously they have to collect that cover that collection cost. Because of that, in the non-banking lending space for the MSMEs, the rates continue to be higher. But I can assure you that as far as the lending to MSME by the commercial banks, they're extremely competitive rate, considering the default rates, historical default rates, and probability of default and LGDs. If you are factoring the credit costs into this thing, I think they're at much affordable cost. The second point in terms of the public sector banks being in the forefront, I think you made a very valid point in the sense that not even a single day the public sector banks did not make the services available during the pandemic. 99% of our branches across the industry have been operational. And we, mind you, during this period, the crores of Jan Dhan women beneficiaries have got the payouts. And I think that if you consider that part, the social inclusion agenda of the government and the social inclusion agenda of the very purpose of public sector banks is to a large extent fulfilled in my view.
Why somebody like the former governor at Reserve Bank of India, Raghuram Raju, who's very much from the Chicago school, said that he saw a very strong case for the continuance of public sector banks in India. But I'm afraid, gentlemen, it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Ajay and Mr. Shetty, please stay with us. We have to slip into a very short commercial break.